Well, hello, everyone. Welcome to Getting Started with Technical Analysis. My name is Barbara Armstrong. I'm a coach and senior manager with Charles Schwab. I have the privilege of having Connie Hill with us in the chat today, along with all of you. She is a friend and a fellow coach and understands all the concepts that we are talking about today in spades and then some. So what is on the agenda for today? Well, this is the last Getting Started with Technical Analysis class of the year. And so I thought I would sweeten the pot for us a little because I know that a lot of people are looking out to the new year and they're coming up with goals and they're coming up with plans. And so based on that, I thought it might be handy for us to look at a plan or an example trading plan. So we are going to look at how we might use trend and how we might use moving averages to create a simple example trading plan for stock investing. And so that's what we're going to do today. If you are not following Connie and I on X, I don't know what you're waiting for. You're missing lots of great content. It's a way for us to be able to communicate with you and you with us outside of webcasts like this. My handle at Barb Armstrong CS, Connie's at Connie Hill CS. So I want to say hello. If anyone is here for the very first time, please feel free to type a greeting into the chat so that we can welcome you. And to all the usual suspects, I welcome you back. And we've got to say, I've been here and gone a lot, traveling with the in-person event team and then taking a few days to spend Christmas with my family. But it's great to see so many familiar faces. So hello to Paul and Jack and Marcus and Ricebird and Will and the rest of the gang. Thank you all for being here and for bringing this chat to life. So without further ado, let's go through, just review a couple of important components before we get into our main topic today. And that is that everything we discuss here is for general information purposes only, none of it to be construed as a recommendation on the part of Schwab or myself. Also know that we will use the paper money platform on the Thinkorswim desktop platform when we look at our stock examples today. There are some nuances and differences between the live platform and the paper money platform. But, for what we're talking about today, it looks like, smells like, feels like real money, and it is a great place to practice. We are going to talk a lot about stop loss orders today, and it's important to keep in mind that stop loss orders do not guarantee that you will get out at the price requested. If a stock gaps down, you could be out at a significantly lower price, but it is an attempt to manage our risk and sometimes protect our profit, unrealized gains in our account. So, we teach this in a 9-week rotation, and then sometimes we'll throw in a couple of bonuses. So the last 2 weeks have been bonuses. At last week, Rachel filled in for me, and she taught a class on Fibonacci retracements. And if you missed that, you'll want to go back and see that one. And then I did one the week before, kind of the 8 things I wish I'd known about trading when I got started. And so if you missed that, you may want to catch that as well. We'll go back to week 1 next week. Okay. And so really what the plan for today is to look at trend. We're going to focus on uptrend today. We're going to look at a moving average, and then we're going to create that example trading plan. If you have never been to an in-person event, the schedule is up and complete for the first quarter. So January through the end of March. Kevin Horner, Rachel and Dashel and Ben will all be in Dallas with the in-person event team, on January 9th and 10th. So I encourage you to join them there for a 2-day workshop. I'll be at the workshops in Bellevue, which is the Seattle area, at the end of January, along with Ben, and then in Sacramento, February 6th and 7th. For these 2-day workshops, it's easy to register. They're free. We'll have the coffee on. We provide breakfast and lunch. And they are really a great immersive event. I've never gone to one as a client that I didn't walk away strategies that I could use or things that made it very worth my while to attend. And I love going to them still as a coach and getting the opportunity to meet all of you. So there's that. You go to schwab.com/events to register. Okay. And if you know that you want to go, don't wait too long because, we have limited capacity at these and we have to close registration. So the idea with technical analysis is that price moves in trends and stocks can only really go one of three ways, right? They can go up, they can go down, or they can go sideways. And price is a reflection of the current collective market knowledge. So it's taking into account international trade and what's going on with tariffs and if new products are coming out, if people tend to be spending money, currently, or if, they're holding their wallets a little tighter. So the market is taking everything that it knows into account in determining the price of a stock. Now, having said that, and you're going to see, when we look at trend, that just because a stock has moved one way in the past doesn't mean it's going to continue that way in the future, but history tends to repeat itself. And if it doesn't repeat itself, I don't know why this is not. Hey, hold on. Oh, great. Here we go. History will often repeat itself. And they say if it doesn't repeat itself, it rhymes. And why is that? Even though the technology behind trading has changed a lot since, say, the 1920s, human beings tend to react similarly in similar situations. And this is why history, will often repeat itself. Yeah. So this is why looking at the charts, I find so exciting. It makes me feel like I have an ability to make a more informed decision about what might be happening or what my expectation might be for that stock. And trends reflect supply and demand. So if there are a lot of people wanting to buy the stock, then there isn't as much supply. Supply is the number of shares available, right? And demand is the number of people who want to buy those shares. So stocks, the price tends to go up when you have strong demand. People will pay what they need to pay to be able to buy something they want to buy. And when demand exceeds supply, it drives the price up. Now, when everybody is trying to sell, there aren't as many buyers. And so, people will sell at a discount or they'll sell at a lower price just to be able to exit a position. Okay, so when we see something downtrending, it means we've got lots of people wanting to sell or excessive supply and not as many buyers interested. Okay. And, when we think about that, that makes sense, right? Right. Okay. So if we're looking to identify a trend and we're looking here at, a stock that is uptrending, and stocks, even within this overall uptrend, where, whoops, sorry, I thought I'd changed my. We have seen periods where it was going up and then it pulled back. And we're going to talk about this in weeks to come, but that might be identified as a bull flag, and then it moves up again and it pulls back. And so the longer intermediate term trend is uptrending, but within that, we see, movement up and down, and a pullback is technically called a retracement. So when the price gets high, buyers, like, let's say it's an institution who wants to take a big position, they can't just go in and buy 1 million shares or the price would skyrocket. So they go in and they buy a little bit day to day. and every day they're buying more, and then the price is driven up, and then they stop buying and let the price come down a bit, and then start buying again, and it takes the price back up. And now, I'm not saying that this is all due to institutional buyers, but they can have a role to play in it. So price can slip back down even within the context of an uptrend. And just because something is pulling back for a few days, it doesn't mean the overall uptrend is now over. Now, there are times when, and we say the trend is your friend until it ends. Sometimes an uptrend does come to a halt. And we talk about these trend reversal patterns over this 9-week period as well. So, and today we're going to focus on uptrends, because we're looking at buying a stock, and, we're looking at an example trading plan for buying a stock. And so, typically, or at least one of the times when someone may consider adding a position to their portfolio is when something is uptrending. Okay. And an uptrend is also described as a bullish trend. And what we're seeing here is higher lows. We're seeing higher lows, and we're seeing higher highs. And by adding a trend line to your chart, it can just lead the eye. But it's defined as a series of higher highs and higher lows. And the expectation is that if it is in motion, that it will continue in motion. Okay. And so the idea isn't always to buy at the lowest possible price. You can buy in the midst of an uptrend, and if you get the middle 60%, or 50% even, sometimes you can do quite well. And the uptrend, when is that considered over or broken, is when the price, we no longer have a higher low. So if this came down, and instead of going up, it came down and we created a lower low, and then it came up and maybe started going sideways, and this previous low all of a sudden becomes a ceiling, or a point of what they call resistance. So we would call this a break of the trend if we don't continue to get higher lows and higher highs. All right. So by adding a moving average to the chart, and this is, a 30 period. And why do we say 30 period? Well, if you're looking at a daily chart, this could be a 30-minute chart. It could be, or a 1-minute chart. It could be a 1-day chart. So this could represent, 30 days, a 30-day moving average. It could be a 30-week moving average. But it just kind of helps smooth out the price fluctuations and makes it easier to see the general direction. And, what we call a faster moving average, so a 30-day as opposed to a 100-day, will tend to move more and might produce false indications of trend changes. So here it might look like the trend is starting to go down, where it's really just a dip and it continues up. Where if we had a 100-day moving average on the chart, and you're going to see an example of that shortly, where I have a 100-day moving average on the chart. But if we have a 100-day moving average, that line might look kind of more like this, because it's taking over 3 times as much data. The 30-day moving average, or 30-period moving average, is adding up the last 30 days and dividing by 30. This is adding up 100 days worth of data and then dividing. And so this line is going to move slower. And that makes sense too. So, and we'll talk about the advantage and disadvantage potentially of using one type of moving average versus another, and when you might do that. And so like here, we see this blue line giving us a long-term trend. And with the intermediate term trend, like that looks like what I call a Tums chart. It's going to give you indigestion because it moves up and then comes, it seems down a long way, but we still have a series of higher lows and higher highs on the longer term trend. On the intermediate term trend, it seems to be uptrending and then downtrending, and then uptrending and then downtrending. So your time frame is important. And we would refer to long term as something longer than a year, and then intermediate being 3 months to a year, and short term being, less than 3 months. Okay. So it depends on, what your objective is and the time frame that you're setting out for yourself to achieve it. So I met someone in Chicago, and their goal was to make $100,000 a year in income through their investing. So they basically wanted to make $2,000 a week. So they may have set a weekly goal or a monthly goal for their trading. Someone else might say, I just want my account to grow over the next 20 years. And so they might not be looking to pull any money out of their account from an income perspective. And so it's important, and you may have a large account, like you might have $1 million account, and you might have sectioned your account and have different goals for each section. So maybe a part of your $1 million you want to generate an income, and a part you want to continue to be invested for longer term growth. Okay, so today we're going to look at something that you could use either way, and that trading plan could be modified and you could use it either way. But it's important that you choose both technical indicators and a plan that helps you match your objective. Okay. And I know it's kind of like a blinding glimpse of the obvious to say that, but sometimes people don't even have a plan, or they don't have an objective, and that can be part of the problem. So let's go out and look at how we might use trend. We're going to look at Google in a few minutes, but I came across this stock, and I drew a lot of lines on this before we started. This is AngloGold. If you are not familiar with this company, it is based in Colorado, and it's a gold mining company, and they're in Africa, Australia, and the Americas, and it was incorporated in 1944. And so, this would be, in the materials sector, right? And so if we want to look at a trading plan, and here I'm going to just an example trading plan for stock investing. First of all, what's our objective, or what is our goal? And so if an objective might be to invest in, stocks with a longer term investment horizon. So that might be a goal. Another goal might be to generate, a trend trading growth stock. So this might be a trend trading growth stock plan to generate annual income. So, this is up to you. It's your trading plan. But if we say, well, what we'd like to do is a shorter term view, we'd like to go with the second one, a trend trading growth stock plan. What are we going to buy? So what stock might we choose? Well, we're looking for stocks that are uptrending. And you might say, I also want the sector that stock is in to be uptrending, ideally. And maybe you want the overall market to be uptrending. that might be part of the criteria you are looking at. You might say, well, when it comes to what to buy, I want the stock to trade at least 250,000 shares per day. Or some might say, I want it to be 1 million shares a day. Now, you might make it 1 million shares a day if you want to be able to sell a covered call or use a protective put over earnings. And so, and why would you care about that? Well, because if the stock trades 1 million shares a day, it's more likely to offer options. Or you might even just say, I don't want to buy a stock that I don't have the ability, to buy a protective put on. And so you might even put that in your what to buy group. And then when are you going to buy it? So you might say, well, when there is a bullish technical entry. And what is a bullish technical entry? Well, that might include, a bounce off support, a bull flag with a close above the high of the low day. It could be a breakout above resistance. It could be a move, and one of our entries may be a green arrow on a moving average. And your moving average, we may say, we want this to be a 30-day moving average. Now, if you want to be a longer term investor, you might say, well, I want to use a 100-day moving average. And when we go through this example, we'll point out why a trader might choose that. So these are just some of the potential entries. Okay, but when we look at this company right now, we can see that it's uptrending. We're seeing a series of higher lows, right? And a series of higher highs. And, year to date, the stock is up 279%. You might say, well, we've missed it. It's absolutely too late to buy. But what we might say is, well, we have the trend going in our favor. And who's to say that it might not continue uptrending? When we look at some other stocks like NVIDIA, they've had runs where, it kept on going. But one of the things that we want to make sure we do is understand, when we're going to exit if it doesn't go in our favor. So we're looking at when to buy. We're also looking at how much to buy. So if we look at this and we say, okay, we have an entry, here's our entry. It's been uptrending. We have this bull flag. It dropped down yesterday. And today we have a close above the high of the low day. And so if we say, well, okay, I'd like to buy, how much am I going to buy? Somebody's asking if I'm teaching trading a smaller account on Friday. Yes, I am. So be there, be square. It'll be our first class of the new year. So this is, let's say we had $1 million account. So our position sizing, this is how much to buy, is also known more formally as position sizing. We're going to say we don't want it to be our max position size is 5% of our account size. And if I round to $1 million, because it's just over $1 million, that would, in this example, equal 50,000. So we don't want to buy more than $50,000 worth of any one stock or index or whatever it is that we're buying. And then our max loss per trade, so if we're going to buy some stock today, we might say, well, we want that to be in our trading a smaller account, we've made it 2%. But it could be 1%. It could be a half of 1% if you have a large account, or a third of 1%. Whatever, or you might just say like, hey, I'm new. I don't want to risk more than $1,000 and I have a $10 million account. Well, you can make it whatever you want. But, if we went with, in this case, our example of half of 1%, that would be, on a $1 million account, that would be 5,000. And so if we want to use, if we're saying we don't want to risk more than 5,000, if we don't put a stop loss on it, then technically speaking, we could buy $5,000 worth of stock because it could go to zero. And although a stop doesn't guarantee that we're going to get out at a particular price, if we say, well, hey, this recent low yesterday, the low was 83.79. So I am going to take that 83.79 and I'm going to multiply it by 0.97. So if it goes 3% below that, 83.79 times 0.97, I'm going to put my stop in at 81.27. So, and I'm going to draw, if we buy this today, if I put my stop in at 81.27, how much am I risking per share? Oops, 81.27. This would be our stop. And again, this doesn't guarantee that we'll get out at the price requested. But, and you might say, well, I don't want to give it that much room. But if you don't give it some room, it could have a one-day pullback like it just did, and we could end up stopped out, and then it can turn around and keep on going up. And that kind of frosts your petunias when that happens. So we might say we want to put a stop 3% below a recent low or a recent support level. Okay. And that's when we're going to sell. Now, during earnings, and you might want to put this right into your trading plan, you might choose, you might say you're going to replace your stop loss order with a protective put. Now, some people don't do that, but if some stocks tend to gap down or up on earnings, that might be included in your plan. You might put that in your plan and you might say, yeah, I never use options in any way, shape, or form. Well, then you wouldn't put that in your plan. So Jack, James Boyd just taught a whole class on callers today, which is, selling a covered call and buying a protective put. I'm not going to go into that for this introductory level class. But it's a good question, and I like your question. And so if we come down here and we change this to our calculator and we say, okay, I am willing to put a stop here at 81.27. If I buy today at 86 on 89, and I subtract that stop of 81.27, oops, 81. Dang it. Okay, minus 86.95. 86.89 rather. So we're risking $5.62 a share. And so if we say, okay, I'm willing to risk 5,000, we could probably buy like 800 shares. But the other piece is that we don't want a position, that's higher than 50,000. So if we bought 500 shares, we'd probably be, around 40,000. So let's say we buy 500 shares. We're risking $5.62 a share. So if I multiply that by 500 shares, we're risking 2,810 if we got out at the stop price requested. So, and we could end up out at a lower price. So it gives us a little wiggle room that, we could have the stock gap down and get out at a lower price and perhaps still not exceed this max loss per trade of 5,000. Okay, so, and if we bought 500 shares, so if we buy custom with a stop and we say, okay, we're willing to buy 500 shares, or that's our position size, how much would that cost us? 43,000. And so, why are we not buying 600? Because that would tip us over the 50,000 mark. And we don't want to go over that, yet we want the ability to be able to maybe sell a covered call if it started to go sideways. So this is why some investors might say, I'm going to buy, if I have this size of account, I'm going to buy, 100 at a time if I can. And then we're going to put our stop at 81.27. Confirm and send. And then we're going to put that in our trend trading growth stock. And you might say, well, how long do you intend? Just a sec. Yeah, this is that account. We're going to put that in our growth stock. Okay. So we've sent that in. Now let's go back in time. And I thought that I would let's go back to the 9-month mark. So let's say we had bought this, and this idea of our sell is that our routine is to update our stop when the stock closes below the 30-day moving average. To 3% below the low of the day. And then if we end up out, our entry is when it breaks back above the 30-day moving average or, bounces off a support level. So, this is our routine to manage it once we're in. Okay, so somebody's asking how I make all these different folds. So what I did here is I just went in ahead of time and I drew some lines. So, and I said, well, if we were going to say, if we looked out a year, and let's say we had been following this stock and somebody, we looked at it, it was uptrending, and then this stock crosses our radar, it bounces off the 30-day moving average. It looks like the uptrend is continuing. So let's say we had bought it on this day for 36.42. And if we're following this plan, we would say, okay, where was the recent low? Well, the recent low was here. And so our low that day was 31.91. And if we put our stop 3% below that, that's where our first stop would have been, our first stop loss order at 30.95. And then it turned out it went up, it pulled back. And if our routine is that we update our stop when it closes below the 30-day moving average, even though it was kind of worrisome when it pulled back here, did it close below the 30-day moving average? It didn't. And so we might just say, well, we're just going to let it do its thing. and our stop loss order would remain. But when it closed below our 30-day moving average, so here's our routine is that we're going to update our stop. So this is our plan. So we know when we're going to update it before we even place the trade. So on this day, it closed at 39.61. And so if we had put our stop 3% below, that stop would have been 39.61 times 0.97 at 38.42. It went down to 38.61. So we just narrowly avoided being stopped out. And then it turned around and continued to go up. But we've updated our stop. And what are we attempting to do in updating that stop? Our attempt is to protect some of our profit because we bought at 36.42. So now we're hoping to, if we get stopped out, at least to get out with a little bit, okay? A little bit of profit. And again, no guarantee with a stop, but it continues to go up. And then the next time it closes below, it actually gapped down that day. And it closed, the low of that day was 43.44. So then we would have updated our stop again to 3% below. And then it continued all on up. So now we're attempting, to protect a little more of our profit, but enjoy the uptrend if it continues. And then we would have updated our stop again here when it closed at 44.67. And then again here when it closed. And if some are saying like, hey, where did you get that red arrow? That's kind of handy. If you go to studies and edit studies, and we've added a simple moving average just by typing it in over here, simple moving average, and you add it. But you'll see here it says 30, 0, yes. I put that yes in by going to the sprocket and it says show breakout signals. And then it will show the green arrows and the red arrows. The default is no. Okay. So that's why those arrows are showing up. So we've updated. So we're checking this. We're checking our position daily. And then it keeps going up. And on this day, we updated our stop and we ended up stopped out. Now, are we crying? Well, we might be the next day because it continued to go up. But we got nicked out. Now, what happened here, and I'm going to come out to the 9-month mark. So this is why some investors, when it comes to earnings, they put a protective put on to avoid the potential of being stopped out, but to give them an exit should they need it. So we got stopped out, and let's just assume we were able to get out at the price that we had our stop set at, which was 45.86. We still managed to exit for a profit. But then if we still like this stock 2 days later, we had a green arrow the next day, we might have said, okay, we're going to, buy back in and restart our position. Now, the disadvantage of this is that depending on the type of account, it can create, something you have to discuss with your accountant, and that you'll have to talk to your accountant about. But if we look at this, we sold for 45.86. So our net profit was 45.86 minus our entry price, which was 36.42. So if we look at that and we say, well, we did not too badly, 45.86 minus 36.42. We made $9.44 a share. And then times 500 shares. So we were up $4,720. And, you know, based on an investment of 36.42, our return on our investment, if we take that 9.44 and we divide it by our entry price of 36.42, 9.44 divided by 36.42, it's 25.9. It was a 20, almost a 26%. If I round up, it was 25.9%. A return on investment for a trade that we were in, you know, for a few months. So that was our net profit on the first round. And then if we got back in, you know, on this date and got out again, we would have been out for another nice profit and nice return. And then we would have stayed out until it crossed the 30-day moving average. And if we had bought on this day, you know, when it was around $74, we would be in that trade still. And so that's just kind of walking you back over, you know, how this might work. Okay. And so there's an example trading plan. Also, if you look in the trade management mini sessions, I've created a similar example trading plan there that you can go and review at your pleasure. This class will also be available in the archives. But we've placed a new position today. And if you wanted to go and practice, you could look at a stock like Google and go back and kind of go through that process of, if I got in here, you know, where would I have put my stop? When would I have updated it? You know, and technically, if you're waiting for that close below the 30-day moving average, let me just wipe that clean. Your first stop would have been here, then you would have updated it here, and then here. And you would have been in, you know, at this price, it was what, under $200 a share, between 160 and 170, and it's now trading at 314. But, you know, if you weren't in this position, you know, would there be an entry today? And some might say yes. And so you could start your plan now. So I hope you have found this helpful. I'd appreciate it if you would hit the like button. It helps move this up in the algorithms on YouTube so more people can find this content. So if you hit the like button, I'd appreciate that. Subscribe to the channel if you haven't done that already. Make sure you follow us in the land of X. My handle, Barb Armstrong CS, Connie's Connie Hill CS. Next week, there are some changes to the schedule. So just so you're aware of what those are, you will want to go to schwab.com/coaching. And this will be in the show notes down below. And let me just bring this up here. So if you come to live webcasts, this is also where you come to in-person events to see, you know, the live events. But so this is December. If you come to January, I saw somebody saying that they loved Connie's ETF class, and you will see that starting next week. Okay, that's starting next week. The Investing in ETFs is back, and it will be taught by Rachel Dashel. Also, building a stock portfolio, you know, that we're putting a new label and a new kind of focus on this class that Kevin Horner has been teaching. It was called After the Close. It's now going to become Building a Stock Portfolio. And we're adding a class called Investing in Dividend Stocks. And so we've got some new things coming your way. I hope you'll check them out. Thank you so much for joining me today. Have a really great day. Thanks to Connie and the guys behind the scenes for all that they do to bring this to life. I will see you actually later this afternoon. I'm teaching After the Close, which is going to become Building a Stock Portfolio. So I'll see you at 4 o'clock Eastern if you'd like to join me for that. Take care, everyone. Bye for now.